This is Jonathan Mickles with the Strategic Multifamily Investing Podcast. And today I have with me another repeat guest, Mr. David Blatt. How's it going, David?
All right. Thanks for having me back.
Absolutely, man. The last time we talked, you were working in some multifamily investing, and then you were going to set up a fund to start working on, I think, distressed office. So just for everybody else who's here, give us a little bit more about your background before this past year or so that we last talked.
Sure. So I have always had a background in distressed debt. I managed a distressed debt fund for over 10 years. And this was into and through last recession, entirely focused on commercial real estate assets. So just buying bad loans from lenders of all profiles and working through those. So I would say that, one, I'm very comfortable getting involved in more complex situations, and I'm opportunistic by nature. So, the market's been really great for a decade, since we came out of the Great Recession. And it was never really kind of like the right time to really support a distressed only fund. And then when COVID happened, we had some lender relationships that were offering up some portfolios of loans. Some of them were in default, some of them not. And we were able to jump in on those. And that's really what precipitated the creation and launch of CapStack's current fund, which has been in operations now we just closed out our second year, where we're really focused much more broadly within real estate on the debt space. So looking at things, again, with an opportunistic lens, like bridge loans, mezz loans, and we're buying distressed debt as well whenever we see those. But it doesn't live or die by a market cycle or particular strategy, which is what really the distressed fund that I managed was like. So that's really where the focus has been. I would say that the opportunities were tight when we started because the market rebounded so strongly coming out of COVID. And there was so much money chasing deals that, we certainly were able to find opportunities, but, it was much more competitive, and we had to keep our yield expectation and return expectation much tighter. I think that that's definitely changed, certainly over the last year with rate movements and a lot of the inflationary headlines and everything that we're reading about.
So let me ask this question, and so we can kind of get into the sweet spot of who your clients are and who people, who are interested in particularly the space or who may need you in the future can really dial in on that. So what range of units are you looking at, or what loan value are you looking at, or loan to cost are you talking about? You're talking 1 million,
Yeah.
2 million. Where is that sweet spot for you?
So I would say that we've been looking at senior loans, as little as, let's say, 3 million up to 25 million. The mezzanine preferred equity type financing that we've been doing is probably more around 1 to 10. We're coming in behind lenders, and I would say that's probably like picked up as lenders have pulled back on their LTC, LTV advances,
Right.
but still think it's a good loan, good borrower, good story. So we're coming in behind them just to complete the debt stack, with that incremental amount.
How does that work down? Let me ask that question, because from a multifamily perspective, and I know you're across multiple asset classes here on the commercial side. Are you only doing commercial, or are you doing residential and commercial, or just commercial, just only?
So I define commercial as business purpose. We're not lending to owner occupied borrowers.
Gotcha.
There's an entire industry there. So, if someone's investing in a portfolio of single families That's fine as long as the intention is profit, and not as a primary. So
Gotcha.
that's really what I would that's the catch-all for commercial real estate to me versus residential real estate.
Okay. Now, in the past, what we've done is we would underwrite to maybe 75, 80%, depending on how the bank was, happy about that. But as you mentioned, that they have started pulling back on those loans. So initially it was, okay, the bank is going to give us 75% of this. We're going to have to raise 25% plus whatever CapEx that we may be able to have. And that's kind of how it works. But you're talking about you come in behind the banks. Is this after you close? Because right now, I think we're at about 60, 65%, if you will, that a lot of banks are lending. Are you bringing in that extra 10% after the close, or how does one underwrite that in as you part of the deal?
So I mean, it's usually pre-close because the borrower needs that capital, right? They've got their equity slug coming in, the lender's coming to the table with their senior piece, and there's a gap in the middle.
Got
So,
it.
we're really, we're executing this gap trade, if you will. Sometimes it's borrower driven, sometimes it's lender driven, because we have relationships on both sides, where ultimately, the debt stack, if you will, has to be solved, right? So the senior is, like you said, coming in short 60, 65, whatever that may be, and they need to come in with that last 10%. So it has to close there. Therefore, they have to identify who's going to be able to do it. Otherwise, they're short proceeds. The lender is not going to finance a deal where there's an expectation that the borrower is just going to be able to get it somehow.
Right.
And the borrower is not going to want to put money at risk if they're being responsible about their investment to do the same.
So you'd be subordinate to the bank, say, in this particular situation.
Yes,
Now,
that's right.
you mentioned that it's short-term debt. So then is that like a year, 3 years, 2 years? What is short term?
And that's a good question, right? Because you have various lenders who will define that very differently. For us, right now, based on where we are in the market and where we feel like the market's trending, we're really looking at no more than 1 year positions. And ideally, I want a borrower who's got a business plan that has a very high likelihood of an earlier repayment of our loan. Now, the reasoning for us isn't so much that it's that like kind of quick turn, hard money profile per se. It's more that the market's been moving so fast, and let me be specific. The capital markets are really what's been moving so quickly, and the real estate market still remains this big, slow, fixed asset and has been playing a ton of catch up. So, part of it is a function of, okay, cash flows, what the debt service looks like, valuations and repricings. Like, we can talk about that in theory and, just point to formulaically where it needs to be. But real estate and behind even the asset, the people, right? The humanistic factor associated with like such a quick move by the capital markets is taking time to process. And so it's playing catch up, but it's playing catch up to the downside, and just a function of a pullback.
Okay.
And so for us, we're still saying, okay, we believe in the asset class, we believe in good deals, and deals get done on a deal by deal, right? We're not making macro bets, even if we're viewing the market on a macro basis. So from that perspective, we're active. We like jumping in. We're being opportunistic. We're being thoughtful about the downside, but we're also saying, okay, the market's trending in a particular direction. Real estate still has to align with where the capital markets have moved so fast. And so based on that, I don't necessarily want to be locked into something for a matter of years. And there are
Gotcha.
lenders who are comfortable with that, but that's just where we are. I just want to like be in, be out, try to be as nimble as we can possibly be to just get a better feel for, a point where ideally, we can see some form of stabilization or just, a new reality that seems to have a little more longevity. I think we're much more transitional now.
You alluded to the capital markets versus the real estate markets. And, for those who are novice out there, can you break down the difference between the two? The capital markets are, the real estate market is, and how have capital markets been, historically responding? And are you that sensitive to the rate increases that the feds have been giving us recently?
So the capital markets versus the real estate markets, in the most simplistic sense, is just a function of the money versus the asset, right? And obviously you're taking money to invest in this asset, and there is a very well developed financing structure and market and players. It's so robust, and more so than so many other industries out there, which is what makes it so attractive, right? That you could come to the table, putting aside the nominal zeros that sometimes real estate requires of you, right? From a percentage basis, right? Talking about LTVs, where you have a participant who's passive and is willing to take majority of the risk from the perspective of 70, 80 LTV, right? Which is huge, just putting aside, the fact that we're accustomed to it as an industry standard.
Right.
Or at least recognizing that to be the case. And the only thing that's really being asked from that participant is a fixed rate. It's just pay me my money back and give me a fixed rate. The evergreen nature of owning this thing, if you want it generationally or if you want it for a few months, if all, and the upside associated, that's all yours. Just give me my currently, single low double digit potentially, coupon, and repay me, and I'm good.
Right.
Even though I'm taking way more risk than you are.
Right.
So, that's the capital, right? And then you've got, the real estate. So the capital markets historically, and certainly, well, first of all, over the last 10 years, and not only have they been stable, but the rates have been so favorable on the debt side, that it's just created a level of predictability. And it's also created a significant amount of capital availability. So basically, there's been so much money available for real estate that it's driven prices up, year over year,
right,
where people could reliably underwrite appreciation just from a perspective of demand, and also not enough assets being available, right? Just from an economic sense, supply was not meeting demand, prices went up.
But are you starting to see that slow down now in the capital markets?
Yeah, absolutely.
Okay.
You're starting to see it slow down. You're starting to see almost like a freeze.
Okay.
If I'm a buyer, okay, and I can no longer access 70 or 80%, but like you said, 60%. Not only that, but that 60% costs way more.
Oh yeah. Yeah, we're much more than what we were talking before. Yeah.
A lot more. So, the money costs money, and you're getting a lot less of it, and you have sellers who have yet to process, and this is just the reconciliation that is taking place right now, where sellers have to recognize, okay, pricing is no longer where it was, even if your asset is just trophy, or you took it from 0 occupancy to 100%, or you bumped rents, or your business plan was followed through to a T, and you achieved everything you achieved.
You're still gonna be
right. Unfortunately, you come out the other side and everything about what you predicted was dead on, but for the fact that the value you attached to that being repriced downward as a result of the capital markets informing on that.
But then in that particular case, as a seller, then I wouldn't necessarily be using you. I just have to reduce my price, which I don't want to do, which hurts me on the other side with my investors, because we were predicting potentially something else.
Sure.
Would they potentially want to say go for another round? For example, generally most real estate is purchased, at least on the multifamily side, for 3 to 5 years, right? That's kind of the plan that they use to turn things around. You in that situation, if I'm trying to say buy another property, I'm only getting 65%. I'm coming in with, you know, whatever equity that I have, and you're going to make up the rest of it. You're rescuing that, or if I'm a seller and I need to turn this around, and I'm not going to be able to get all the money that I really need, do I bring you in? It seems like I can't even bring you in that situation because the markets are soft, if you will, because my pricing has gone down. If I'm trying to, at the end of I'm trying to get out of my 3 to 5 year, I really can't bring you into that to return capital back to my investors.
So it's a combination of a number of things, and you're raising some good points that have yet to be addressed
Okay.
By the market. And I think that is also why you're seeing it's less of a pullback from lenders, because they've taken a position and more a wait and see on how a lot of those things get resolved and reconciled. There's a sense that, okay, if the rate increases just at some point, get to that new normal and stabilize within a particular range, then that will allow everybody to just start planning and projecting out based on that, and understand how to essentially execute and value. So as it relates to where, our trade and how we would jump in to facilitate. So, there are sellers, if we're going to take the sell side, who, you're right, may have been into, let's say, a multifamily asset for 3 to 5 years, executed that value add business plan, got there, and now, either they don't want to take the haircut on the sale, or, they expected to refinance at a much higher number that delivered either cash out or traded down in rate, and neither of those things are on the table any longer. So to that end, we would step in and, they might say, okay, you know what, I just need some like breathing room here. My loan is maturing.
Okay.
And I need to just buy some time, and, I need a year. So there's a situation, where essentially the commodity that we're selling is a year, right? And there's a price tag associated. So but that's essentially the trade.
Why would I want to come to you versus going to doing a cash call?
Because the cash call is not available to you. Right? If you're, let's say, assuming you have syndicated capital in a deal, meaning you've passed the hat to your private investors, there's nothing worse than having them pony up into a deal where, your proposition to them is, we've just gotten hammered and I need you, investor, to float me.
Yep.
Secondly, some deals have already experienced a cash out refi. And the last thing you want to do is approach that same investor and go, psych, I need that money back.
Gotcha.
I mean, so from an optics and call it IR, investor relations standpoint,
yeah,
that's a little bit the kiss of death on your prospect of, raising money for future deals.
True.
So, secondly, just common equity, right, from investors is generally the most expensive equity.
Got it.
The most expensive capital, rather. Right. So, just if you think about that stack, right, it's the riskiest, but it also gets the upside participation. If you're going to call more of that capital, presuming it's even available to you, it's going to create a dilution on the overall return. And if you are built on delivering certain hurdles of return to be able to earn your money and earn a living, you're really diluting that down. So those are a number of reasons why you would really look to some more structured finance solution, that looks like debt, even if it has a pricier coupon, and like the tag maybe gives you a bit sticker shock based on what you've seen in the market, but from a relative cost standpoint, would be the better option.
So can I, but I come to David and I say, hey, David, I'm a seller. I'm in this situation. I need another year or so. Thought I was going to be able to do it and execute it. Everything is great and fine and wonderful with the world. And you step in and say, yes. So then the impact to the other passive investors in the situation is that they're going to get a lower cash flow amount because we're now having to pay an additional loan on the property in order to bridge this until we can actually, finally cash out refi in another year or so. Am I correct in saying that?
I think that that's definitely a form of pain that an investment or a deal could feel.
Yeah.
And it's a little bit of a pick your poison situation.
Exactly. And I think with investor relations, as you mentioned before, it's important. One of the things that if you're doing a syndicated deal, everybody has is that piece of the form that says, here are all the risks. You could lose all your money, da 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 da. And if you've been acting in good faith and you've been in, consistent communication with the investors, letting them know what's happening. And of course, they're seeing what's going on in the market. And this is a potential low cost situation in that they don't have to pony up any more money. They may get less cash flow per month or per quarter, however you do your distributions. But then it at least solves a problem temporarily before you can actually finish executing the plan for exit. You know what I mean? So that's
absolutely
that's definitely another option there. So let me ask you this question then. I'm sorry, were you about to say something else? That I cut you out there.
No,
In
no.
terms of where you see us going, I mean, obviously, your money is at a year, and trying to come in and doing that mezz, debt piece, which is perfectly fine. But where do you see the markets actually going? We've been talking about a recession, and then we've had 2 quarters of downturn, and no one is using the R word, right? So, what do you see? I've heard different things from different people. As a matter of fact, I was just talking with somebody. Yeah, go ahead. Yeah,
I'll tell you. Listen, the market's in a recession, right?
Okay.
And if you want to argue me on the scientific definition of what a recession is, sure. Okay. But at least let's zoom in. The real estate market is in a recession. Okay. The valuations are adjusting downward. Certain asset classes are feeling a lot of pain. There is billions of dollars of loans that are going to be maturing over the next few years that don't have a clearly defined exit as to how those get repaid. So, those are some serious red flags. And now listen, the market could come back should the capital markets on a macro level and the economy on a macro level, turn the inflation narrative around, right? But if you look at just again, economically, the concern of the Fed, which is driving a lot of this, being inflation, they are deliberately trying to hit the brakes on the pace of growth across the board. So, I mean, that in and of itself, that slowdown, I mean, just from the definition of the word, they're trying to affect a receding of economic growth, granted to a positive pace, but something that's been much, much slower than has been in the past, right? So real estate's there, right? The real estate capital markets are there. There are other industries that are experiencing that as well. And, it's uneven, but 100%, that is where we are. And there are certain things that need to get solved, or at least there has to be a very clear path to that solution for us to be able to then point to, okay, I think we're at a bottom or around there. And, for a certain longer horizon, or I can buy in for X dollars for this time frame, and I feel like I'm money good in terms of both asset preservation and then appreciation. But I mean, nobody's going to go out there and reasonably take a bet like that unless, on a specific deal level, you're buying so right, which is possible.
Right. And well, with any real estate transaction, if it cash flows now, it will cash flow later. So If it's
Sure.
a good deal now, then it's a good deal. And your perfect person who you want to reach out to you is someone who's purchasing, who recognizes there's a gap between what you can raise and what the bank is going to give you, and you need some additional depth in order to get to your goal to reposition an asset. This is probably not a stable asset, right? This is probably one that needs to perform quickly so that they can increase the rents or whatever in order to be able to repay you back within a year. Am I correct in saying that?
Yeah, I mean, listen, my box is really just a view on the direction of the market. And granted, look, I manage a fund. We're trying to generate a return. We want to see exits on our investments within a certain time frame based on that. But overall, we're calibrating to the market. A year ago, 2-year deals and 3-year deals were certainly on the table because our view was that that was a good place to be making loans for the fund. But I'm constantly just looking at the real estate market as a whole, thinking about where I can participate in that ecosystem, but at the same time also here is just generally speaking how I tend to think about things, and frankly how any investor really needs to think about things. What is your counterparty trying to solve for them?
Okay.
So for us, that manifests both from the end borrower who is, let's say, trying to either buy an asset and affect a turnaround plan, buy time, so things like that, or is presented with an opportunity where the seller has to exit out before their loan maturity and they have to move very quickly. These are just expressions of different ways that we're thinking about, okay, what are you solving and where can I fit into facilitating that if I'm interested? On the lender side, similarly, what are lenders trying to do? A lot of the traditional lenders are trying to play serious defense right now. They're trying to, generate business potentially, or maybe they're just like pencils down and not generating business, because the reason that's happening is not even a view on the market. A lot of banks have just essentially just gone dark on doing real estate lending because depositors have been taking money out of their bank because across the street they're getting a half point more on a savings account than they were getting at the bank. Like, this is a real
This is a real
situation.
thing. Yeah.
It's very real. A lot of banks have been like seeing their cash drop because people are shopping,
Right.
which is like, and that has this cascading effect, so by understanding certain drivers, even on that side, if a bank is open but they're short proceeds, we come in on the gap like I described.
Right.
If they can't take the pain of a good loan, let's say maturity defaulting, then we're able to step in and take that down. But the reason that we're doing it is not simply because we exist. It's because I'm taking the time to figure out the things that people are trying to solve, both for the upside and trying to solve with respect to pain points that they're experiencing in the
Right.
current market environment. And that is just, generally speaking, I don't care where you play. Like, you need to be thinking about that
Right.
to be able to create enough of a pipeline of quality, and then also be, you get first look on these things when you can just like, communicate both implicitly and explicitly to the other side of the table. Like, I understand what you're trying to get to.
Right.
Here is how we can make this deal happen, and I can facilitate that.
So then let's talk about this, David. How do people get in contact with you? What's the name of your fund, first of all?
So, I mean, the firm's name is CapStack Partners. The fund is very inspiringly CapStack Real Estate Credit Fund. So there's no mistaking what it is. And we have a website. I'm best reached on LinkedIn.
So David Blatt on LinkedIn. And that's the best way to reach you. And your website, what's the website address, just so people can?
CapStackPartners.com.
There you go. Well, listen, David, this has been very interesting. And as you mentioned earlier in our pre-conversation, complicated. For those of you who are in deals and you know you're coming out of a deal or you're getting into a deal, and you're thinking, I don't know if I want to do it. David's the person that you need to talk to, because he's in the weeds. He's making it happen, and making things more accessible to all of us here to make sure that our deals get done, no matter what the real estate transaction is. So please make sure, and of course it's non-owner occupied stuff. So please make sure you reach out to David for any of those things. Again, thank you so much for coming back, David, and we look forward to talking to you very soon. All right.
Thanks for having me.
Absolutely.